Welcome to the Greenleaf podcast.
Oh, I don't have that kind of a voice, but we'll get started anyways. Welcome to the Greenleaf podcast. Today, we have Kris Benson with us from Blueline Ventures, which is a new group you just launched here recently this year. So excited to talk about what you've been up to.
Me too. Thanks for having us. Josh, Dave, appreciate you having me on. It's going to be a fun conversation.
So I like the pullover. This is nice.
Yeah. The first thing you have to do with any business venture is get shirts embroidered with swag. That makes you real.
That makes it official?
Yeah.
Do you have like a vest version too? You need the vest.
Not yet. If I did, I probably would have worn it. Josh has his vest on. I probably could have worn it, but no vest. But what is cool is after a while, you end up with a closet full of clothes that are only embroidered with your business name and you have no other clothes. So it makes it challenging, like when you go out to dinner with your wife and those types of things where you're always wearing branded gear.
It's good though.
Or it makes it simple.
Yeah, that's easy.
Or simple.
Like Steve Jobs had the best wardrobe ever.
Yeah, black T-shirt. Not a bad way to go.
I don't think it was branded with Apple stuff on it.
No,
It was just black. Yeah. You get to that's a different level though. Exactly. I think that wardrobe is a different level.
Turned out okay.
What about pants? Any pants?
No. You think maybe I should do like a tearaway?
Yeah.
Like an Adidas tearaway and it just says Blueline down and I just...
When you get ready to work for the day, you're like, let's get these things off. I'm going to get right to it. Crank out this computer time and go.
Yeah. I hadn't thought about that, but something for the future. We're working on our 2025 goals, so maybe that can be one of the things.
Yeah, you throw that in there. Mm-hmm. Who designed the logo?
We have two, actually. One is so Blueline Ventures, just a little bit of background, and you guys won't care, and you guys can edit this out if you want. But so I played hockey, and one of my partners played hockey, and we both played defense. So the blue line is where we lived. And so on the logo, the line is actually blue, but it doesn't work in all different colors of shirts. So the BLV, the line, is the blue line on an ice rink.
Very cool.
All right.
Yeah. How'd you come up with Greenleaf?
We just wanted a logo. We wanted a name that just wasn't our name.
It was clean. It was consistent. It was warm. Inviting.
You just picked it randomly?
Warm? No. So I think you got to go back to like personality tests. We like all that stuff.
Yeah.
But if we took one, we used one called Culture Index, and it assesses like your
Culture Index,
creativity or ingenuity and that stuff.
What's your profile?
Ours is pretty low.
What's your profile?
I'm an enterpriser.
Yeah, me too. What are you?
I'm the persuader.
Okay.
Yeah. Close to rainmaker, but more persuader.
Yeah.
Yeah. Enterprise. So
your creativity was
low creativity, which is then
and very high level of impatience. Mm-hmm. So it's like, all right, Greenleaf it is.
So there's 5 partners in Blueline Ventures. All of us are all gas, no brake. There's only one guy, one of the 5. He's the only guy who has any brakes. So it's perfect. In like investment committee discussions, there's one person who pushes back, and the rest of us is like, let's just go. So it works out great.
Beautiful.
Where are you guys located?
Everywhere. So I'm here in Atlanta where we are today. I have a partner in Charleston, a partner in Austin, Texas, a partner in Boston, and the 5th guy is just outside of Hartford in Connecticut. So we're kind of spread out. I think over time, our goal in the next 2 or 3 years is we'll consolidate to an office. I'm pushing for out west. I want to be in the mountains, but there's only 2 great airports out west, Salt Lake and Denver. So we kind of pick one between there. We'll see. Everybody's kind of in a different season of their lives. My kids are older and grown, so we have a little bit more flexibility than everybody else. But
yeah. Salt Lake City Airport is excellent, though.
So is Denver.
Salt Lake City's got better Sky Lounge. Denver doesn't have one.
Okay. Yeah, I guess if you're measuring.
And just to get to residential from Denver.
Yeah,
it's kind of a haul. Salt Lake is right there.
We're thinking Boulder. I really like Boulder. It's 45 minutes to the airport. It's pretty easy. But we'll see. I think, you think about when you're starting a company, and I know when you start something, sometimes you think about this, or otherwise you just kind of fall into it. But from our perspective, it's also access to talent. Like, where are we going to get people? You guys are in Atlanta. You got an incredible talent pool that you can pull from. And so, both Salt Lake and Denver, strong. You got strong population growth, good demographics. So we'll see where it ends up.
So you got to convince Boston to leave the greatest city on earth, and then Austin, Texas to leave the other greatest city on earth, in their opinions.
Not full time, though. So, like, he doesn't want to be in Texas in the summer. It's the worst place on the planet. Austin, like, in July is awful, worse than here. So he, he's interested from like June to
for a little bit. Yeah. Makes sense.
So
how do you guys all know each other? It's 5 is all over the country. It's kind of a mix.
So interestingly, and we can kind of get into the story, but I resigned from Reliant Real Estate Management, the company I was a part of before, at the end of 23. I'm part of a mastermind group. Dave actually was a part of it many years ago called GoBundance.
I was in it too.
Oh, you were in it too, Josh. Sorry.
A lot of years.
So the 4 out of the 5 are in GoBundance.
Ah, okay.
2 of the guys were buying businesses already together, just individually. And then the 2 other partners, myself and a guy by the name of Paresh Mehta, basically retired at the right time and all had interest in going into private equity. And so we kind of joined forces, and that's where Blueline came from. So yeah, been really fun so far.
When did you guys officially launch? Or when did you start it together? Because you started the company and you're working on a fund structure with it too, right?
Yeah, that's right. So I would say this summer was sort of the official where the 5 of us were together. Previous to that, Joe and Bo, and we thought we would all change our names to rhyme so we could be maybe
There
like
you go.
Mo, but we didn't. But Joe and Bo had purchased 4 businesses on their own outside of a fund structure. Just that was the beginning. A metal manufacturing company. They do like HVAC tunneling, custom metal machine shop type stuff. They have a telehealth company and then a home healthcare company. And then Bo has 2 businesses actually in Boston. So they had started it, and this was just sort of the formalizing what the structure looks like going forward and how we could scale it.
Very cool.
Yeah, it's been super fun. It's an incredible industry. Obviously, I was a real estate guy, and it required some rejiggering of how you think about things, but fascinating world.
How does the real estate play into the new venture? And from your perspective, right, it's like you're probably still looking at things from a real estate lens. I saw one of the companies that you guys, I think you already purchased, was the sign company that installs signs on real estate.
Yeah.
Right. So there still is very much a real estate perspective to it.
Yeah. I mean, I'd say the biggest place that it plays, Josh, is specifically in most of the sellers own real estate, right? Their manufacturing facility, their office, something we're shooting for companies that have 10-year plus operating history. So most of them have some component of real estate in their business. Some of them are leasing it. A lot of them own it. To be candid, putting money into the real estate is not the best use of capital relative to what we're doing. So like, we're just a capital allocator, just like you guys, right? Like, it's investors are trusting you to allocate capital to the highest and best use. And when we're looking at deals, we're looking at the real estate as sort of a distraction. And we haven't bought one yet, but if we buy a company where the real estate has to be included, have you guys seen like the sale leaseback companies?
Yeah, I know we've done that with operators too, where it's a big part of the capital stack if you're buying the business and the real estate together, and they're kind of very different business strategies. Yeah. So putting those in one thing is always a little messy.
For sure. And it just gives you the liquidity. It allows you to focus on one thing, which is operating and growing that particular business, not worrying about, just what you guys do every day. I don't want to deal with maintenance, lease, et cetera. We want to figure out how do we grow EBITDA in the business that we just purchased. So I would say it informs you just from an investment standpoint. We're doing the same type of underwriting and have the same type of underwriting metrics that we would look in with real estate, but just slight tweaks about how do you make differences in them. So yeah, I think that's probably the best bet.
I mean, you came from a big real estate shop. I mean, you guys were national.
Yeah.
I mean, were there any states you weren't in?
It was mostly the Southeast. So when I left, Reliant Real Estate Management is a vertically integrated self-storage operator. So we bought and managed self-storage properties primarily across the Southeast. It was, if you looked at sort of the demographic trends over the last 10 years where population was going, generally that's where we had storage facilities. But yeah, we were top 20 self-storage operator in the country, had a lot of facilities, raised a bunch of money. And we were a value add shop, not doing too much on the development side. So we were buying existing facilities and then trying to find a way to grow net operating income. And to be honest, that's kind of what we're doing at Blueline, right? We're just a value add shop, but instead of real estate, what you guys are doing here, right? You're going to reevaluate the best use of this building. We're just doing it at a business. So very similar.
When you look at those businesses, are you kind of assessing your target as size of the business or industry of the business?
So I think both. I would call us opportunistic. So we've only purchased one, right? So our N is 1 right now. Hopefully by the end of the year, we'll have another 1, maybe 2 under contract. But what we see, and this is just my own personal belief, and I think this is part of our strategy, is Do you guys know who Brad Jacobs is? The guy who did United Rentals. There's a great book called How to Make a Few $1 billion. He has taken 8 companies from 0 to $1 billion. He's done pretty well in the private equity space, M&A world. And he has this quote that basically is like, if you get the trend right, you can make a ton of mistakes and still make a bunch of money. And the trend that's happening in the world that we're operating is boomers are retiring, right? So you have this huge flux of people who are 60 plus years old saying, hey, I've spent the last 20 years of my life building this business. What do I do with it? Some have plans with their kids or there's next generation or somebody to hand down to, but most don't. And that's what we're trying to ride, Dave. So in the space of M&A and private equity, we consider ourselves kind of lower middle market or like micro equity. We're chasing EBITDA between $1 million and $3 million, right? So for people who don't know EBITDA, it's basically just profit, a different way to measure it. And what that does is it's too big for kind of, Josh to go buy the business on his own, and it's too small for big boy private equity to care. Yeah. So it's this sweet spot where, at least initially, we're not seeing a lot of competition. It would be like you guys going into office right now, right? Like as you're buying an office building, you don't have 15 bids. Or if you do, they're all super low ball. So it's not like we're competing against 20 buyers because there aren't that many that are playing in that space.
Have you installed any signs?
Personally, no. So
not that, yeah.
We only do gas station signage. The other part of our buy box is weird niche stuff that you don't even know exists.
So you mean like gas station sign with all the pricing on it and all that kind of stuff?
Anything outside the store. So usually like the canopy, we're doing all those stickers on the pumps, all the painting, the signage out front, the big signs sometimes that are 2-3 stories up. This guy carved out an incredible niche. It's a very interesting, weird world in the oil and gas space. And if, Josh, you own a gas station and you have a Shell contract and Dave is a salesperson for BP and he gets you to swap, when you swap, you have to rebrand the whole facility. That's what we do. We don't have to cover or manufacture the signs. They just ship it to us, and then we go install it.
Oh, it's purely installing.
Yeah, so BP knows exactly what they're like. You're putting this in.
Yep.
We're sending it to install this bad boy.
We have a design team in-house that is working with the client to work through renderings and say, like, hey, does this look okay? You want it like this? As long as it fits within BP's specs or whatever the national retailer is.
Constantly in real estate, we're battling like permitting and zoning and approvals and sight lines and all that stuff. Are all these signs like, they just work at every location?
No, we have permitting. We have a permitting team whose job it is to go figure that out. Yeah. So, this. Some municipalities are worse than others. But remember, unless it's a de novo, but even if it's de novo, someone got the gas station approved before we got there. So a lot of times,
it has rights for a certain sign in a certain location and size. Yeah.
So we're working within confines that already exist. We're not coming in most of the time and saying, hey, we want to do this, and they don't have it.
Have you done a Bucky sign yet?
No, too big.
Do you take a photo every time you get one up? I'm like, look at this cool thing we put up every time.
I don't, but yes, we do because the customer has to see it, right? So that's how they're getting approved to get paid, and we can submit those. There's photos that have to fit a certain way for us to get invoicing paid.
Oh, that's like real photos. I was talking more on the joke photos of look at all these cool signs.
Well, is part of the play to go to Denver is to get the come and go signs?
At that or what's Loaf and Jug?
Stations. Yeah,
Loaf and Jug is another
great one. Yeah.
What about Space Station Gas? That's my favorite gas station.
Yeah.
But that one. That's a location of one. So.
All growth opportunities, guys. Yeah. All growth opportunities for Blueline Ventures and CMB Sign Group.
Is this adjacent to billboards and billboard installations or not at all?
To be quite candid, there is. So we're 5 months into that business, and we think there's probably a roll up just in that space. Because it's this weird fragmented market where what they do, there aren't many people who do it with the professionalism that they do. And they're only operating basically in a 4-hour window around Cincinnati. So their customers who are oil and gas station signers are, you may own a gas station in Cincinnati or Milford, Ohio, but you also might own stuff in Northern Michigan. And you say, hey, can you come do these? And today, Steve and the CMB Sign Group are saying no.
Yeah, we're 4 hours, and that's our sweet spot.
So I think what we're looking at next is having a strong customer say to us, here's where we can expand, and then we'll make the investment to either go buy a sign company in that area, or potentially just build a warehouse there. Ostensibly, all there is guys and trucks.
When you think about business strategies, I mean, there's the roll up and exit private equity play, but then there's the other side of the coin, which is buy a business, operate, and just keep growing the margin, keep growing the business, and you don't necessarily always have to have a roll up and exit strategy.
Yeah.
Are you going into it with one of those game plans in mind, or back to opportunistic?
You talked about the fund structure. So our idea with the fund structure is truly permanent equity, which in our world is 10 years, which, for us, that's forever, basically, right? I mean, if we're asking somebody to give us their money for 10 years, that's a long time. But what it allows us to do is make great decisions with the business with long-term in mind. Right? Most private equity is coming in with a 3 to 5 year window. They're going to try to slam as much profit as they can in that window and then trade the business. Well, that's not always best for the business. So the 10-year hold for us this is truly a cash flow play. If there are opportunities for the roll-up side and we can trade it, we're going to be opportunistic, right? It's just math, right? I mean, ostensibly, if we buy something at 4 times EBITDA and we get it to 8 times, it's probably worth recycling that capital. But you guys know this in the real estate space. When you sell something and make a bunch of money, you got to do something with it. And there's reinvestment risk, the tax consequences of selling. So it's not always great, especially if something's just kicking off cash to trade. But I think we're taking it with a long term, but we'll obviously be opportunistic along the way. And there may be that roll-up strategy that punches us in the face, and we just say, oh, there it is. Let's go buy 10 of those.
Are your capital stack on doing these kind of things, is there financing available for buying businesses?
Yeah, so we've assumed 50%, right? So we buy something for $10 million, 5 is going to come from a bank, 5 is going to come from investor equity or the fund. We've been pleasantly surprised the market that is available with smaller regional banks for these types of acquisitions. I mean, remember, Dave, these are not de novo. These businesses has been around, 10, 20 years. So many times, I mean, the bank has operating history to underwrite off of. Some are CapEx heavy, where you have a bunch of machinery and equipment, right? Like the sign company, there's trucks. There's nothing really there. So for the collateral of the bank, we were kind of concerned that the bank really has nothing to go get if things go wrong. But what they kind of sunk their teeth into is, C&B Signs has literally 30 years of financial history. And, it's not always at the same revenue level, but they're comfortable with that as the collateral. So generally, we're trying to go in low leverage, 50%, and then, that puts us in a position from a debt service coverage standpoint. Most of the time, we're buying these with 2+ DSCRs day one. So we feel really comfortable that, if things go poorly, we got a lot of leeway in what that debt structure or being able to pay the debt.
Yeah, kind of relating that to real estate a little bit, like debt service coverage in real estate, they want to see like 1.4. And you're like, okay, 1.4 means you earn, your net is 1.4 times what your total debt payment is. If you get over 2 in real estate, it's kind of like, man, this deal is humming along and cranking out cash. So you're always above that.
I wouldn't say always, but most of the
Your
stuff
target
we're underwriting is starting there. So coming from a real estate background, my partner, Joe, when he first told me what he was doing here, and Dave, I may have told you the story, but he's like, Kris, tell me what the last multiple of profit, the last storage facility you bought, what was the multiple of profit you bought it at? And I was like, well, we don't really value it that way. We're looking at NOI and cap rate. He's like, yeah, I don't care. He's like, just go find out what your NOI was and tell me how long it would take you to get your money back if you just got that for the rest of the time you held it. And I think when I looked it up, it was like 28 times. So that means if the NOI stayed the same for 28 years, then I'd have my money back. That's how long it would take me. He's like, cool. He's like, I just bought a metal mat fab company in Charlotte. He's like, I bought it for 3.8 times. He's like, so if I do nothing, I get my money back in 3.8 years. And I was like, that's interesting. So Dave, to your point, like think of it in cap rate terms. If we buy something at 4 times, that's a 25 cap, right?
Yeah.
And that doesn't exist in real estate.
No, it used to. One of the first real estate deals I did, I bought at we used to look at gross rent multiple. So like how much you paying over your total gross rent. And it was 3. I was like, hey, as long as we're below 3, we're good. And then that would turn into like a net multiple of around 7. So like I'll get all my money back in 7 years. My gross rent is sometimes I'm paying, double what the rent was. Now it's like you're paying 20 plus X what that is.
And what's happened, and this is our thesis, maybe if a lot of listeners listen to this show, we'll be in trouble, but you guys know this, when capital finds yield, right? So once people figure out you can make money in something, money pours into it and it drives the returns away, right? It's happened in every real estate asset class in the history of the world. Self-storage 10 years ago in 2014.
Like capitalism is efficient. If it finds it, it's going to go there.
So like, self-storage used to be able to buy stuff at like 8 caps, right? In 2021, those are trading at like 3s, 3.5, 4, right? So, my opinion is in 10 years, the same thing will happen here. We're in a market today that I believe is just being undervalued, right? So theoretically, 10 years from now, 15 years from now, there'll be more capital chasing this type of stuff because people will realize, holy crap, like these things are producing 20 plus cash on cash returns a year. And they're, the risk is different. I don't argue that. But the conversation that everybody says initially, the first response is like, well, it's riskier. Real estate always has value. The real estate does, but the owners change, and it's happening right now. We're seeing it in the cycle. Guys are losing deals all over the place, right? So for that investor, the real estate still has value, but they lost all their money. So it doesn't matter that intrinsically the building has
It's not going to bring them any comfort. Okay, it's still worth 50% of what you paid for it, so it's still worth money.
Right, but it's not your money anymore.
Yeah.
The bank gets paid and that.
But you think about that, like if you're able to buy stuff at basically a 4-year payback, what's the incentive to sell sometimes? Do most people want to sell and exit, or most people like, hey, we want to stay on board and keep working and keep doing this, but we do have to be able to take some chips off the table.
You're saying like from the seller standpoint.
Yeah. So like, is it are you normally looking to fully buy something, or like you just want to get into it and you keep that team and that ownership that's there and they get to de-risk a little bit, get some of their chips off the table because it's probably one of their biggest assets.
Yeah.
Right.
Probably the biggest asset, right? They've spent their whole lives. And I think this is something that we're incorporating into our buy boxes. The perfect scenario, Dave, is a guy or gal. This is the lifeblood of their business or of their life, right? The business is them. Their people are the people that they've, brought up over the last 20 years. They're maniacal about the product quality. That's what matters the most. Like you can see it when you meet the sellers. Some guys, just like the sign company, Steve, what he cares about the most is the quality of the product that gets put in front of the customers. And that's why a customer will wait 13 months to have a job done because they know it'll be done right. So to your point, the perfect scenario for us is a guy who says, I want to take some chips off the table. I'm 64. It's time. I'm going to put some money into my pocket, but I still want to be here. I want to go watch it go from 5 million in top line revenue to 10 to 15. Most of these guys, Dave, are great 0 to 1 guys. Like they worked really hard to get it from nothing to something, but from a sophistication and business savvy level, they're not the guy to take it from 1 to 10. They just don't have that in them. They're just workers who've worked really hard to build something, and they work in the business, not necessarily on the business. So they're willing to take chips off the table and then say, can you guys help me grow?
And would you say that's part of the DNA of Blueline is that you're not a de novo company? You're not I would say the 0 to 1 guys. You're the guys that go from 1 to 10 and 1 to 20.
100%, because the pitch we're making to investors is we're trying to de-risk by buying a company that has existed for 10 years. We're not trying to get product fit, right? This is something that, has existed for 10 plus years. There's already a market. So we're trying to de-risk from that perspective. And I think where we think we believe value or bring value to these types of companies is just an outsider's view who has diverse experience. It would just be like you guys talking to another office operator, right? Yeah. Like you have a ton of experience where you can just look at it and say, why are you doing it this way? Have you thought about this? The thing that stands out to me in my background, especially on the capital raising side, is no business at this level, at least that we've looked at yet, has a sophisticated sales and marketing program. 0. Steve, CMB Signs, does not have a website. there is not a phone number online that you can find if you want to do business with them.
Josh is getting excited because he's like, can we do that strategy and get rid of our websites and everything?
But that's like, and you ask like, hey, how are you driving organic growth? And they're like, we just pick up the phone. And those are the kinds of businesses.
The man.
Right.
Yeah, she's got to be the man.
But those are the kind of businesses that and the reason people call him is because he's maniacal about quality. The product he puts out, everybody knows is incredible. So that's one of the big value adds, like the lever that we feel like we can pull is we were out in Houston this week looking at a company, the guy has a product that fills a need that nobody knows about. And I asked him, he has one outside sales guy. And I was like, talk me through like his comp plan. How do you guys structure his day-to-day? He's like, I don't even talk to him. I'm like, well, how do you know what he's doing? He's like, I don't. He's like, at the end of the year, he's like, we just kind of divvy up, like, this came from you, this came from us, and we pay him. Like, okay. And he said it. He's like, look, I don't know how to build a sales team. I know I need it, but I don't know how.
Yeah. But he knows how to make the product. He knows how to make the product perfect.
Yep. Maniacal about quality, right? Like that's what he cares about the most is
that's a unique identifier when you're looking at stuff because you can tell when you go into a place if they are or if they are not.
I would say the other thing, and it's just starting to kind of come into clarity, I guess, for lack of a better term, but the fact that we go sit with the sellers as part of the due diligence process matters. These guys and gals, they want an extension of their legacy. It's not all about chips off the table. They want their people to go forward, and they want the business to go forward, and they want to do it with people who are good people. And I think that's another key component. Like he talked to us about that guy in Houston talked to us about 3 or 4 of the other business guys that he has talked to about through this selling process. And he's like, look, when you come to me with a spreadsheet and say, here's what your business is worth, this is what I care about, and there's nothing else, he's like, it's a black or white decision, right? And when you build a relationship with these guys, you may not be the highest bidder, but it may be the guy that you want to work with for the next 5 years. And I think that really matters. Where in real estate, it's a little bit different, right? Like you're buying an asset. There's no people involved. In this, you're buying people. I don't mean to say it that way. That probably doesn't sound.
That makes sense.
Exactly.
No, right. You're buying like an
human capital.
Operating organization.
Right.
Typically, real estate is not an organization. You're buying a physical structure that you're going to take your organization and put them there to execute it. So you already have your team. You're not going to buy a new one really in real estate.
Yeah, and like with Greenleaf, right? If you guys sold the business today, the operation to somebody else, you're going to care about, the gals behind the camera, right? Like you're going to care like what happens to those people. And if it's just, we don't care, they're done, you're probably not going to be as interested to sell that to that buyer.
Buildings sometimes, so it's like
selfish.
No, buildings, but sometimes people have the right price. It's like, well, where do you want the keys?
Right, exactly.
You can have it. We're not concerned with what you're going to do with it. You can do whatever you want to do with this thing. It's yours now. You own it.
Yep.
But not people.
Agreed.
Yeah. With the seller, are they? I understand your point about the people are staying. They care very much about the people. But are they still involved in the day-to-day? Do they want to earn out? Are they going to hang around for 1, 2, 3, 5 years, or are they kind of becoming kind of fully passive once you buy?
The answer is it depends.
Okay,
and that's part of the thing.
What do you want? Like, what would be
the perfect scenario for us? Is the seller is Steve, right? Yeah. CMB Signs. He doesn't want anything to do with the day-to-day anymore. All Steve wants to do is talk to customers.
Yeah. He's going to go out and make sure every sign is perfect. And if it's not perfect, he's like, hey, right here.
and they've trusted this guy for 20 plus years. So when Steve walks in the door, it's a warm relationship, right? And no one's going to know more about his customers and the signs than him. We're never going to learn that, even if we bring a CEO. So what we're doing there is we're hiring a COO to run and build process at the office. Steve is terrible at it, doesn't want to do it. But if we're going to scale, like if we're going to double in size, we have to have great people and great process. But we want Steve to be there to be out selling to customers. So the answer is that's the perfect Juan scenario for us, but every seller has a different feel. And it's funny when you talk to them, there's a broker community just like in real estate. The brokers think one thing. And when you talk to them, they're like, look, I don't golf. Like I have no hobbies. This is what I do. He's like, so I still want to be here. He's like, do I want to deal with an insurance audit every year? No, I don't want anything to do with that. But every guy and gal and their situation is a little bit different. But most of the ones that we're trying to talk to is let's partner with a future. And that could be, Josh, you mentioned an earnout, and what that means is, ostensibly if they continue to grow, the owner still has equity that they are benefiting from that equity growth and value. And so what that does is just aligns our incentives.
Right.
And so we're just trying to find ways to partner and align, and we want you to benefit from the growth you've set up for the next 3 years. Like if you go from 8 million to 12 million to 15 million, you should benefit too. And so I think it's just about finding, what it is that they want, and then being able to create a structure that allows them to do that.
So you go meet new owners or potential guys you could do a deal with or whatever. Is the whole team going?
No, not generally. There's 5 of us. That's a little obnoxious.
All 5 roll in?
We sit on one side of the table at dinner, and then there's just one guy on the other, and we're just like, no, usually, I'd say of the 5 of us, culture index wise, 3 of us are the right people to have those conversations, right? Just, who we are as people.
Not the brakes guy.
The brakes guy, probably not. We have an architect, and he's pretty cold isn't quite the right word, but he's,
calculated. That's like a calculated person.
He's very calculated. And so like when you sit down at dinner with him, your first impression is like, you're kind of a weirdo.
Yeah.
Great guy, super smart, but like in initial conversation.
Where's our architect?
Do you have one?
He's not here. Andrew.
Yeah.
He's architect.
Yep.
But yeah, you're like, what the? Yeah.
Yeah.
So it's about just everybody's got a superpower, right? And I think deploying the right people to do the right things is a key component of it. And to tap on the culture index, for those of you guys that don't know what it is, think DISC assessment, personality test to determine who you are. And there's a profile, and ostensibly gives you insight to who the person really is and what they'd be great at. And for us, for this to work at scale, for Blueline to work at scale, we got to have great people. And so this is just another way for us to build the org chart with people that we think have the right profile.
Yeah, we look at that too, of just how to communicate with someone else. Mm-hmm. Like if you want to verbally talk about something, or I want to just see it in writing, it's like, well, we got to kind of come to the middle here, and I'm going to have to talk to you a little bit, and you're going to have to write some stuff down occasionally. Yeah. So we can actually get there.
I could see you running into many sellers that are architects that built, to your point about being meticulous about their business. Maybe they aren't the best salesperson, but they built an incredible business or process and they don't necessarily want to be social. They want to go out there and stare at the damn sign. Mm-hmm. So we can go talk as long as we're staring at the sign.
Yeah, their sales pitch is the exacting quality that they do everything. They're like, look, my work speaks for itself. Right. That's like architect.
And it depends where that seller's background is too, though, right? Like if you had an engineer and he started a business around engineering, right? Like everybody's background's a little bit different, but yeah, as part of our due diligence with the team, whoever's in the team that knows that they're selling, we'll do culture index on, especially key leadership people that are staying. Like we want to understand who they are too, right? Yeah. And that's our best way, other than sitting with them, to also look at their profile and be like, all right, this is what we got. And there's no right or wrong profile. It's just right people in right seats. Like, do we have the right people in the right seat? And what we like to do, like for 2025, we'll have an org chart that's just built out with profiles. It's not names. It's just, this is who we want in this role, and here's who we got. Do we got anybody that fits that? And sometimes it's moving people around, and sometimes it's got to go get somebody new.
Just have your spouses take them?
Yeah, for sure. All my family. I know all of it. My wife's a socializer. I don't know what yours is, but for sure.
Yeah. Not the socializer.
No.
High D traditionalist.
Got it.
So I've got the enterpriser, low D. She's got the traditionalist, high D. She would love to know the plan.
Yeah.
I joke with people like, what is it like? And I'm like, well, it's like if you get in a car and you drive somewhere. My wife is always insistent that you put the directions in before you drive. And I'm always like, we will get the directions as we're going. And you kind of like make the first couple turns wrong, but you eventually get there. That's the dichotomy of.
We should do drive-by with Dave, with him and his wife, and just have a video on the dashboard of just seeing how that goes. Because I bet that's super interesting.
And then she gets car sick, so she's like, she wants to put the directions in, but she gets car sick. She's like, I'm not typing them in. And then if I'm like, all right, I'll just type them in while I'm driving, then she's pissed that I'm typing and driving. It's like, yeah.
Yeah.
And then we have to pull over at the first gas station almost every time.
What's their sign look like?
Most of them are QT. So most of the time I'm like, I'm going to go to a QT. Unless I can get up north where I'm at a Sheetz. Yeah. Sheetz is going to be the first stop. Not Buc-ee's. There's Buc-ee's is like,
going to Buc-ee's.
Okay, you have 226 miles until the next. I'm like, I have 7 stops between now and then.
You also need an hour and a half to go to Buc-ee's. just
A lot
the
of beef
whole
jerky.
process.
There's probably like 35 outside signs on that place, though.
Yeah, it would probably be a great customer to have. I don't think we yet have the scale where we can service a Buc-ee's, but check in with me next year. Maybe.
What's an average contract size in the sign business?
So depends on what they're doing, right? Like, but a full rebranding
full
of a
rebrand,
facility,
yeah.
somewhere in the kind of $30,000 to $50,000 type of range. We do a lot of service work too, right? Where your sign breaks and on the weekend, and you need people to come out and do it. Much more profitable work, smaller ticket size for sure. But it's a little bit of everything depending on what is happening. But I'd say in the high end, kind of in that $30,000 to $50,000 a job range.
We had someone drive over one of ours. Remember, they drove through the whole building in the police chase and crashed into the building. There you go. Sign needs to be replaced.
Yeah. Call us up.
Yeah.
We'll start an Atlanta chapter. We'll do it with you guys.
Just handle the car crashes.
Greenleaf and car crashes. New niche.
There you go.
Exactly.
So you were in Houston.
Mm-hmm.
What other cities you're looking at buying stuff in?
So right now, it's just how convenient is it to get to. So we looked at a piping company in North Dakota. Fascinating business. They lease pipe. So literally, they have a yard with piles and piles of metal pipe. And in the oil and gas industry, when they need temporary piping, people will lease pipe from them. They come pick it up. They don't even deliver it. The margins on
They don't
this-
even deliver it.
Nope.
They just own the pipe and they're just leasing it to someone.
That's it.
This is amazing business.
Amazing business. Even a margin, I think it was high 40s, right? And it's like 5 guys, very little overhead, great little business. But we live in Atlanta, arguably the greatest airport on the planet. Close. I mean, it's amazing.
Yeah.
It took me 7.5 hours to get there. So I was like, for the rest of the guys, Boston, you can kind of get a little, some good flights. Hartford, Connecticut, you're connecting through somewhere. Austin, good airport.
You like flying to Fargo and you got to drive?
Yeah, so that's the challenge, right? So part of it geographically is, can we get there easily? And as we think about where we end up with an office, can we get there within a 2-3 hour flight, right? If we can't, it's going to be hard. When we tried with the sign company, we had one of us there every week for the first 90 days. Literally, we'd show up, spend 2-3 days there just learning, right? And that's the idea, is first 90 days, don't break it. It's just, let's learn what you're doing, see how it works, build trust with the team, or, hopefully bring some value to the team, build trust. And, if you're flying 7 hours, I'm probably not going to be the one signing up every week, but a flight to Cincinnati is 1 hour and 10 minutes.
That's not too bad.
Piece cake, right?
Yeah.
So I think geographically,
So we can do a drive-by. We go to Cincinnati, North Dakota, Houston, and back. That's like a weekend.
Video.
It's like a weekend.
Yeah.
That's a long video.
Yeah.
Yeah. But I think, when you think about it from our side, it's like, well, where can we be, east of the Mississippi that all seems pretty reasonable? And the other thing we're thinking about too is political climate, right? Like, we looked at a business in California and we're all like, right? Like,
We wouldn't even. We just wouldn't look.
yeah. I mean,
It's just a non-starter.
it's hard, right? I mean, it's hard to just make a blanket statement like that, but there are generally states that are more business friendly than others.
Well, and I think you also have the employee culture as well. So when you're talking about the political environment and going to a very different state than what you're used to, you have the business regulations that are really different. You also have the approach to doing business and the people around that, and the customer relationship is very different.
Yeah.
It's a tough one.
Yeah, for sure. And I think you never want to be in a position where a political change can literally end the business, right? Or your business model can go away because, Gavin Newsom is on some new kick. So I think we're thoughtful of it. I wouldn't say that that's in our buy box, but it's certainly something as we're looking at businesses, we're like, I don't know if I want to go there.
Makes sense.
Yeah. Same with real estate, right? You guys are picking
yeah.
markets that you want to be in. Same with us.
And we have to be able to operate in those markets as well.
Right.
Yeah. Anytime we buy something new, too, we got to go get our team to be there. So they got to also want to be there. If they don't want to go there, if you don't want to go there, it's going to be tough.
I remember the first time we drove down Jacksonville. We was like, listen, let's just go rule it out. So we hop in the car and we start driving. Like, what can we look at on the way? So every time we go to Charlotte, we stop at 15, 20 properties on the way. It's only 3.5 hours here. Jacksonville's just under 6 hours. There was literally nothing to stop at. And then we stopped in Columbus to look at the river. Like, maybe we'll go whitewater rafting on the way back.
That's definitely not on the way to Jacksonville.
Yeah,
That's the
right,
opposite
yeah.
direction. You're driving through the middle of Georgia. There's not much there. Okefenokee Swamp, I think.
Yeah.
Yeah,
It's a nice
stop
draw.
there. Yeah.
It's nice.
But
Yeah, it's got to be. I mean, think about it. Like, it's just at scale. Where can you get talent to go to? I was listening to a podcast yesterday who was talking about having kind of remote workers, and his thought was, like they built their headquarters in Dallas, and he's like, but I could get the best talent if I allowed them to be remote. He's like, and then everybody comes to Dallas, usually 2 hours from pretty much anywhere in the country, where big population centers are. And I like that idea, right? Like, I like the idea of, well, let's not put ourselves somewhere and say you have to be in the office every day, and that, it filters out some of the best talent that we can go get. If we end up in Boulder and Dave wants to work for us in Atlanta, great. Let's find a way to make that work. And I think, just like you guys, but specifically in our business, what's going to matter is, do we have great people, right? Because we are a people business. And what's going to matter the most is, do we have the best talent making good decisions for the business day in, day out?
Excellent.
do you think you're going to have like a shared service model where you have some of the stuff where you're able to help out that
Yeah,
kind of
so-
like smaller size business with like, they can't really hire a whole marketing team with 5 million in revenue. Like, that's not going to work, but they could
Yeah.
share one.
The one that stands out first, Dave, is finance, right? Like, so we have a third-party bookkeeping firm right now that we're sort of testing out to see if maybe we can buy them and bring them in at the Blueline level to do everybody's accounting. So, we can streamline that across the board. The marketing one, HR is the other one that, these smaller businesses generally don't have, from a compliance standpoint, any type of HR. And so I think that's a big piece to be able to take that off their plate. And look, it's also an advantage for the seller to say, you're partnering with someone and here's what you get. Yes, we can take some chips off the table.
Yeah.
Here's a sales and marketing team we can deploy. Here's an HR team we can deploy and take that off the table so you can focus on what you want to focus on.
So when you look at your growth going forwards, we've talked a bunch, like we only do individual deals. We don't really do a fund structure on anything. And you're going with a fund structure to grow Blueline going forwards. Did you guys compare like, hey, should we do a fund? Should we do individual deals?
Yeah, I mean, I think of it as it's a risk mitigation strategy, because I think the thing that I'm getting the most from investors, and I'd be curious from even your investors, right? Like, if you're asking a real estate person to invest in private equity M&A that they probably haven't done before, the risk piece is weird, or I think something that is an unknown. I think on our perspective, the idea of the fund was just to diversify that for them. So the other thing, Dave, is in a fund structure, we have a sensitivity analysis, and in our underwriting model, we've underwritten 9 deals that the fund's going to buy. I don't know if we end up with 9 or not, but that was kind of our starting point.
Yeah.
We can take ostensibly 3 of those bankrupt, literally to 0, and an investor will, and on the other 6, our revenue is negative 3% a year for the entire hold period, and an investor still doubles their money. So it was also about building some fluff into, look, we don't think that's what's going to happen, but a downside scenario to have some protection for our investors. So I think we will move forward with a fund structure, and I think it also gives us a much longer term horizon for people, because they're not focused on one business. It's a portfolio of businesses that kind of are all kicking dollars up to the fund.
Yeah. I mean, that makes sense too if you're buying something at 25% EBITDA margin out of the gates.
Yep.
A couple can do really well, and that makes the whole thing.
100%.
You don't even need them all to do really well. You just need a couple to do really well.
That's right.
Tell us, like, from investor expectations, is this, you mentioned 10-year hold. Should you expect distributions on what level of frequency, or is this like a build up and reinvest all profits to keep building? What size check are you generally putting into the fund? What's the total fund size that you're looking to build?
Yeah, all great questions. So fund is structured, $25 million is the targeted raise for our first fund. And think of it as, for us, this is our track record fund, right? Like, we're a new group. There's a lot of experience in the group in different facets, but the 5 of us have not done this before. And we realize, like, that's a risk. So we need a track record. You guys got 10 plus years of track record. It's easy for an investor to say, they're probably going to turn out okay because they've been doing it a long time. So $25 million raise, the minimum investment's $100,000, accredited investors. On that 10-year, we're projecting a 10-year hold, but distributions on a quarterly basis. And to give you a sense, our first distribution for Q3 of the fund's entirety, like we've never made a distribution before. That first distribution, we have a 10% preferred return, is going to meet the annualized 10% preferred return in that first distribution.
Beautiful.
So our second distribution in the history of the company will be returning capital to investors, a portion of their capital. And it's because there's so much cash flow in that initial business. So, we're looking at this as there's a long-term appreciation play for sure, but this is a cash flow play, right? I mean, these are projected high double-digit, high teens, low 20s kind of returns, and those numbers start to get pretty silly as you're returning capital back to investors.
Yeah, I mean, that return of capital, it's like, can it be redeployed? So there's like that balance of like, that's almost like dividends in public companies too. They're like, hey, should we pay this out, or can we just use this internally and use this to fuel the business even more and more?
I think if this was fund 2 or 3,
right?
We can take it. Because it's fund 1, what investors are going to measure us on is how much money did you give me this year? And we're going to have to build that. I think our vision for future vehicles will be more Berkshire model where, hey, let's raise a chunk of money and never raise any money again. And we'll just take that cash, redeploy it into something else, and create your own liquidity, right? Like we'll have to have some NAV where an investor can pull themselves in and out when they need the cash. Otherwise, let's just let that go. Yeah. But it's hard to do that when you don't have a track record.
Makes sense.
And this is a draw-up fund. So if I commit $100,000, you're only calling on the percentage that you need at the time, or are you taking the whole $100,000 right away?
We'll take it upon commitment.
Okay.
Yeah, I mean, so we won't take money if there's not a deal to put it in.
Okay.
So we'll raise and buy. And this is just my personal preference. I personally hate funds where there's a capital commitment or a capital call schedule. I hate sitting on cash that you're going to take from me over the next 18 months.
So let's just clarify that, right? So like if you commit $100,000 to a fund, the capital call version is like, hey, I need 10 of this now, 12 of this in a quarter, maybe 25 in 9 months. So you're like, personally, you should really keep that cash somewhere so you can invest it into the fund.
And you guys probably like me, if I have money sitting somewhere, I'm like, I got to go put it into something.
It doesn't sit there for long. It's like, we normally spent that stuff 2 weeks before it got to the spot where it's sitting. So how do you go put it into something?
But I think we've thought about it as buy and raise and buy, right? Like, so sometimes we may have more deals than money. Sometimes we may have more money than deals. But if we're in a position where, we have more commitments than deals, we'll just say, hey, guys, we're not taking any capital because we're not going to have pressure from the preferred return to deploy into a bad deal. Look, the upside and downside of a first fund is the downside is you don't have any track record. The upside to an investor is if we screw it up, we're out of business. Like that's it, right? Like if we screw up the first fund, that's the end of Blueline Ventures. So, we have a lot of pressure. It's kind of do or die to make sure that we're making good decisions. So we're not going to put ourselves in a position where we have pressure to deploy capital that arguably is not going to a great spot.
And so you left a organization that had a great office, bunch of cool restaurants right there and stuff. So you don't have a physical office right now.
Mm-mm.
What's that like? You're
working on
You're
my
doing
house.
the working from home thing, right?
Yeah, I hate it. That's why I'm pushing for like a Boulder office or something.
How many times do you go to the fridge a day? Like is above or below 15?
Like every time you're on a phone call, you're like, I guess I'll wander over there and see what's in the fridge.
I would just wander in the fridge, open it, look at it, close the door.
The upside is I'm working on my house at the lake. So we moved to our lake house, which is on Lake Lanier, just north of Atlanta. So there's like a little cabin and the fridge is unplugged. So there's nothing in it. So that's where I go because it's quiet and there's no one in it. And so I'm in my own little apartment. I can't really do anything.
He didn't answer the question.
No, he didn't.
He still goes and looks in the fridge. And he's like, darn it, it's been unplugged for like 6 months.
But I think, and I don't know how you guys feel about it, but look, I understand the remote work environment, but for me personally, there's an energy of having people in a room. I like going to an office. Reliant, I liked going to the office every day. And it was because I liked being around the people that we were with as well. And so that's the endeavor eventually with Blueline is we'll have a space where people are going, whether it's full-time or not, don't know the answer to that. But I think there's an energy that is shared when you're in a shared space working towards a common goal.
Absolutely.
Yeah, definitely. We're same way. We've even over the past 5 years, that whole little cycle right there, we were mostly in the office.
Yeah, us too.
Yeah,
entirely.
we didn't really understand the remote work concept. On paper, it looks great, but when you actually start doing, it's like this isn't even remotely fun.
Yeah,
So
that's the
there
fun
has to be a
place.
little bit of fun. Yeah.
So we built something with Blueline Ventures. Have you ever heard of the Netflix Culture Manifesto?
I've read the
Yes.
book.
Yeah.
Yeah.
No, but it was like they put that out of like this.
Oh,
is who-
okay.
it's
They
basically
still
who
put
we
it. They
are.
just put a new version out. It's on their website. If you go to the Netflix website or Google Netflix Culture Manifesto, it's ostensibly who they are. And the first one they did, Dave, I think it was like 2007, Reed Hastings, and it was like 140 slides of like, this is Netflix. And it was Silicon Valley, a big thing around Silicon Valley. So the 5 partners before we started Blueline together, we said, let's put together what this is. And we were really intentional about what we wanted Blueline to be. And, we have a 2-page manifesto that we'll review every year and say like, hey, is this still relevant? But the number one thing in it is we just want to do awesome stuff with awesome people. And the rule is like, if their number comes up on your phone and you're like, they can't be involved in any capacity.
Even the high D guys.
Even the high D guys. So like investors, right? We don't want to take money from people like that. I don't, like if I look at the number on the phone, I'm just like, I don't want to talk to them. We got to get them out. And so I think, you think about that with life, right? Like 20% of our waking hours as human beings, if you live till 80, is spent at work, rough and tough, right? Of your waking hours. Well, why do terrible things? And that's the part, like so many people settle for so long doing things that they don't really like. And so our hope with Blueline is not only are we having fun, but we can push that to the portfolio companies as well, right? Like that's how we can have the biggest impact. I mean, we're trying to create wealth, right? Everybody is, but we've all been fortunate to make some money in our lives and it doesn't make you any happier. I think that's what we look at as like, that's our purpose is how do we impact the greatest number of human beings so that they're like, that was awesome. Like, that was really fun.
Yeah, it does have to be fun.
Dude, you can't see it in the podcast, but there's 3 tricycles just off the stage here. I mean, like you guys have done a really good job of bringing that to, your investors and your community as well.
We've been trying to start a business with one intention of being able to have an annual social event called the Catalina Wine Mixer. So we literally came up with this idea, and we're like, "Look, we're going to call the business to be called Prestige Worldwide to start with." And someone on our team was like, "You're going to call this what?" I was like, "Well, we're going to like start with that, and we'll get there to be an
What's
official
the
name."
business, or it doesn't matter?
Doesn't matter at
Just
all.
Prestige Worldwide.
Yeah.
So
we had the culture prior to having the business.
Yeah.
That's what matters.
That's where we want to
amazing.
get. Yeah,
That's what matters. You guys could lease helicopters.
we have the interview.
Exactly.
We've got the interview structure. It's going to be 2 people, but back to back.
And
With a D?
for those of you guys who has no idea what we're talking about, you should watch Step Brothers, the movie. It's
You need
incredible.
to watch it like 7 times.
Yeah, it's
it
best.
really sets in at 7
Yeah,
times.
the 7th time is it.
But crap! The boats and hose thing threw me off.
When you started talking about like what your profile was on buying, I'm like, you mean like pre-80s Joel or post-80s Joel? That's where my head was going. I just didn't know I could go there or not.
Yeah, I don't know if I thought through it that far. But I mean, look, that's the piece that is exciting every day is like your wake up pumped to do something. And for us, the fun part too is it's very diverse. You're seeing a lot of new businesses. You get to see a lot of stuff and learning about it. Just like, you guys are doing multiple asset classes. It's fun to go learn something new.
Yeah. Finding out like what the cycle is, what's interesting, especially going into any little business, be like, how did you even build this? Where'd this idea even come from? What's the story? Is super cool.
And the fascinating piece about all these guys that we've met with to date is they're just grinders. Like they've just worked their ass off for 20 years and built a really strong business basically because they delivered on quality, right? And there's some exclusions along the way. I'll just tell one funny story. We were on a seller call on a Zoom. So typically what happens is in our world, we have 2 executive assistants who are filtering kind of the top of the funnel of our acquisition model. And they have general desktop underwriting that they're doing. Does it check these boxes? And if it does, it kind of goes to the next step where one of the partners on the team looks at it, and then there's 2 guys, and then they'll bring that to sort of our investment committee. So we had a call with the broker. Seemed like a good guy, went through the numbers, all sounds good. Let's have a call with the seller, set up a call with the seller. They build cell phone towers. Fascinating. Really successful business in the Northeast. So we get like halfway through the call, and one of the partners texts the text chain, and it was like sends just a newspaper article link. Click on the link, and it was the owner who we were talking to on Zoom at that very moment. He had gone to jail for 2.5 years for tax evasion. We're like, all right. So, we at the end of the call, I was like, well, someone has to ask. Like, we got to see like what's going
Who
on.
wants to ask?
So we did. We asked him like, hey, how does this? And it was awkward, but he worked through it well enough. So that was one of the boxes we add to our buy boxes. You have to go see if there is any criminal background on the seller. If there is, probably a pass. Let's not move that one along.
Probably.
But most of the guys are just great guys who've worked their ass off and built a great business.
Are you looking at any criminal enterprises?
Not yet. No.
The seller hasn't gotten caught yet, so
Yeah. So it leaves a
so
lot of
past the
upside.
smell test. Yeah, exactly.
No.
Like you're gonna run Keno out of the gas stations under the books. Keno. It's like that's where we're going.
Could be. There's probably better options, I guess. I mean, look, there's plenty of established illegal opportunities there. Drug running seems to be really, really profitable.
Muling.
What's that?
Muling.
Yeah, we could be
High
drug
risk, high
mules.
return.
Yeah, high risk, high return.
Yep.
Yeah.
It's just a spectrum.
Yeah.
As investors, you just have to choose what end of that spectrum you want to be on.
We're in the anti-jail spectrum.
Yes. Also,
Prefer to avoid that.
if the SEC is watching this, we're just joking. None of that is our true statements.
So, all right, going back to more serious business. At Blueline, have you guys figured out kind of, and as you're looking at these companies, I would, if you're not already screening, but I would ask, are they doing anything to give back to the community? What is their impact or mission statement around impact? Right. So does Steve in Cincinnati, does he give a percentage of profits back to the Boys and Girls Club? Do they volunteer? Like, are you looking at that from a screening standpoint? Does Blueline have a position that they want to implement across their holdings? Or
Yeah.
I'm just more curious how you look at it.
I mean, I think it goes back to that culture piece, right? What you can build there, and some sellers have put more focus on that than others. There was an engineering firm we talked to in Chicago where they had put a ton of work, specifically his wife, into their give back, and they really focused on pet adoption, and they worked with like the ASPCA in their community. They had like a dog of the month that was on their website. They did a lot around the community, specifically with pets. They would bring their dogs into the office. Like, it's all over their website. They have a whole page about it. So they focused specifically on it. So for us, that's a warm and fuzzy, right? Generally, if there's a seller who's put that amount of focus into culture, that's going to bode well for the rest of the organization. But not everybody's like that, right? Was Steve at CMB Signs like that? No. Is he taking care of his guys? Yeah. Like, guys going through a hard time, he needs $500 to pay child support. Steve would cut him a check.
Right.
Like that kind of stuff. I would say the CMB Sign group probably as a whole, it's a rough crew of field installers. Like, they're not out at the local food bank. But I think for us, we'll allow the company culture to determine where that goes. Give back is huge. You guys have experienced a ton of it. And especially if we're successful, we should be giving back to that community. But I think we'll allow the people in the business to say, hey, here's how we think we should do it. But it takes time to build that trust with the team as opposed to just laying it on them and say, we have to do this.
Right.
So I think that will come with time.
Okay.
So your Netflix manifesto is 2 pages long?
I don't know, 2.5,
Working on page 3.
something like that. Why?
We look at, is it more of like this is who we are or this is who we aren't? Because we've looked at
Or,
a lot of
or
like,
this is who we want to be.
I'll send it to you. You can. I'd be happy to get feedback on it. It's more around when we make a decision, does it fit?
Yeah.
Like, this is who we are. This is how we're going to make decisions. These are the types of things we want to do or elicit and people to feel. And if a decision is not going to fit with us, then we're probably off base. So I think Netflix has gone from 140 slides to now it's like a half a page on their website. I think over the time they've gotten it really consolidated. I would say the same thing will happen to us eventually. Our goal is to kind of review it every year in our year-end planning and say, does this still fit us, or do we have to add and subtract? But I think it's, Dave, like if you give it to an employee, they know it's lip service if you're not following it, right? Like I would. If you gave it to me and I read this and then you did something that wasn't, I would come to you and be like that, this doesn't fit, help me understand. And maybe there's a reason, but like those kinds of things are only good if you hold yourselves accountable to them.
yeah,
Otherwise,
could do it.
you destroy the culture because now you've shown them an employee something, and then you don't hold yourselves accountable to it. Now you're just full of hot air. So
when do you guys all get around like the table and have like, because you guys are still very early in the business building thing.
yeah,
When it's super fun and exciting and
honeymoon.
yeah, it's like
honeymoon.
when you like all get around the table and argue about any of the stuff that needs to be hashed out.
Well, I mean, we have standing calls 4 times a week, right? So we're on Zooms 4 times a week, as opposed outside of broker calls, investor calls,
Yeah.
that kind of stuff. But the travel piece has been great, right? Like, like CMB Signs, we have our holiday party on December 19th, right? So we're going to all go in. The 5 of us will be there for the holiday party. The next day we're doing year-end planning with their team and us. So anytime we can, we've tried to make it a commitment that once a month we're together somewhere for a reason. Yeah. We're also trying to keep an eye on cost, right? You're spending rough and tough $1,000 a guy every time you go somewhere. We have an advisory board. They're all coming in the beginning of January. We're going to Porsche Experience. That's an opportunity for us all to be there, right? We're not paying them anything, so we're like, we might as well do something nice. We're like, look, we'll let you.
That's
drive
nice enough. That's pretty cool.
Yeah, it'll be fun. We'll have a great time. But, that's, again, back to the office thing, right? Like, that's where the value of seeing everybody's eyes, every day makes a difference.
Who's going to drive the fastest at the one that's like directly into the wall?
The
So the
turn-
Porsche Experience. Now there's one
Launchpad.
where
Launchpad.
you go full
just go.
speed and you have to wait as last minute and slam on the brakes, but like at the end of that is a wall.
So,
Who's going to put the most gas into that one?
probably me. I crashed my car 2 weekends ago in the mountains of North Georgia. I feel like I'm going to have the fastest lap time too. I've raced a lot. Like I race go-karts and I have a whole bunch of I'm a motorhead type of person. I think most of the advisory boards is going to be pretty laid back. But
You're
we're
out
gonna
there to
gamble.
win.
Yeah.
I'm out there to win.
They let you like time lapse. They have 2 tracks, like an east and a west, and the west track's like a legit high speed, a lot of fun. And we're definitely going to put money on that. I mean, why are we there if not to win?
Everyone else is there to have a good time. You're like, you guys all know you're here to win, right?
We got Ricky Bobby over here.
Put your money in. Second place is the first.
They have the
loser.
off-road track there now too.
Yeah, the other side, but that one's not as fun. They make you like change cars a lot, and the west track
Can't
is
go real fast.
yeah. The west
Yeah,
track
but it's off-road.
Yeah.
it depends what you want to drive. They like if you want like GT3 and GT3 RS, like the high end, you want to go fast and see how they do. That's what I would recommend.
Go fast.
Go fast, don't die.
Cool. All right, Chris, we'll very much enjoy the time.
Yeah.
Thank you for joining us here and telling us about Blueline, and we're excited to see some more branded gear.
Yeah.
See how far you can take
I'll
it.
send you guys a shirt if you want.
We want the pants.
We'll trade
We want the
the
tearaway
tearaway
pants.
All right, I'll work on the tearaway pants, and we'll set up the drive with Dave. You guys want to do Cincinnati to North Dakota?
Yeah, that's it.
Okay.
That was right in our
Perfect.
sweet spot.
Yep.
Yeah.
There's a lot of video editing. Thanks, guys.
Thanks.